Welcome back to another episode of Building Up Your Business, the podcast. My name is Erica Dill. I'm here with Operationally Up. We're here to help your e-commerce and consumer business build for maximum profitability as you grow. This is another fantastic episode. We're joined by Leslee Cohen. And remember, from bombs to order fulfillment, marketing to taxes, learn the stuff from the pros before you step in it. Leslee is here joining us as a managing partner of All Rise Legal Counsel. She is a powerhouse startup attorney who has worked with hundreds of founders and early stage companies to navigate their first and most often important fundraising rounds. Her firm specializes in helping startups raise capital compliant with avoiding the most common legal and structural pitfalls. And now All Rise specializes in helping early stage companies build strong legal foundations from day one, which is a great lead into our episode topic today of understanding that early stage fundraising. Leslee, thank you so much for joining us.
Thank you for having me.
It's going to be a great conversation because I know so many of our listeners out there are all about, we want to get fundraising. We have no idea how to do it. Or we need specialists on how to get fundraising. So this episode is going to be great at giving you some insight on what it really takes and what those steps are in those early stage fundraising efforts. So I'm just going to jump right in. No more of me talking. Let's hear from the pro. So let's start all the way at the beginning. Before a founder even sends out a pitch deck, what should they be thinking about?
So, great question. I think most importantly, they need that, which you refer to, a solid legal foundation. And what does that really mean? First of all, forming an entity of some kind to protect them. Because if you go into business, just you, and you do anything in your capacity of just you individually without an entity, like signing any kind of a contract whatsoever, you can be personally liable. And what that means is, if you get sued, if you owe money to someone, they can come and take your car, your house, your personal assets. So you want to form some type of an entity, and you want to be really strategic about what kind of entity that is. So if you're going to raise money, you want that to be, it will eventually have to be a C corporation. And we can get into that or not, but that's, and then the other choice is a limited liability company, and that can be a great choice for other reasons. But if you're going this money raising route, definitely a C corporation. And so, that's really the solid foundation. And then before you were to put a pitch deck together, you just also want to think through, do I want to raise money? Do I want to go that route? If so, what are the kinds of investors I want to talk to? How much do I need to raise? You don't want to raise too much. You don't want to raise too little. And you want to have a really solid pitch deck, and you want to have practiced that pitch really, really well. You want to have targeted specific investors that like your particular industry. So there's a lot to think about.
And you mentioned so many things in just that one little answer that I'm going to try not to dive too deep in. But the first question that I think people are going to ask is, you said LLC versus C Corp. And I know that you can transition an LLC into a C Corp, but why, you said definitely a C Corp. Tell our listeners why a C Corp.
So definitely a C Corp if you're going to raise money. And there's a bunch of reasons, but the number one reason is that any sophisticated investor is going to require you to be a C Corp because of this concept called Qualified Small Business Stock, QSBS. And what that entails, and the one big beautiful bill that was just passed just doubled down on this concept and made it even more attractive. So what it says is, if someone invests in a company and it's a C Corp and it has less than $75 million in assets, and they hold that investment for 3 years, now it was 5, now it's 3 years, the first $15 million in return that they get is tax-free. That's a huge, crazy benefit. So sophisticated investors will want you to be a C Corp for that purpose. There are exclusions. There are, it's like any law. Sure. It's not that clear cut. There are certain, the biggest exclusions are by industry. There's certain industries that it doesn't apply to. But that's the biggest reason.
Interesting. That's really good to know because I think so many companies out there, when they go to incorporate, they're like LLC and we're done. And they don't, I mean, they may not know exactly what the difference is. And there are different requirements. You have an operating agreement if you're in an LLC, but if you go into like an S Corp or a C Corp, there's other requirements in order to form that business. And so I think a lot of people don't think about where they're going. So I'm really glad that we kind of bring that up for
Yeah,
them.
and people who are not in the startup world, they would say LLC very much understandably because the big difference is that an LLC is what's called a pass-through entity. So
Yeah,
the company doesn't pay any tax. Only the owner, when it distributes out profits, pays income tax on that versus a C corp where the company gets taxed and then the owner gets taxed. So you'd think like, why would anyone want to be a C corp? And I get that, and you wouldn't unless you're raising money.
unless you're raising money. Yeah, and that makes perfect sense. And I'm glad that you helped clear that up. So, kind of actually, this is a perfect tie-in to our next question. What are some of the most common mistakes that you see founders make in their first raise?
So there's three things. So the first one is, and this is even before the raise, is having an agreement with a co-founder.
Okay.
Co-founder relationships go south all the time. Like if you think that the divorce
Yeah.
rate is high amongst individuals, corporate divorces, business divorces, through the roof. Um, I mean, we don't even do dispute resolution, and I would say I get a call from a client, two founders or three founders who just aren't getting along or have different visions for the company, or one works
Sure.
full time still and does this, and the other one quit their job. I would say I get calls 3 times a week with those issues. Like it's constant. So you
Wow.
must have an agreement in place if you have a co-founder as to how you separate. That's really what it's about. Is like if it's not working out, how's that going to go? And like create a very objective roadmap for everyone to follow. So that's number one. I think number two is to give up too much equity. So the first round is usually the raise is on an instrument called a SAFE, a simple agreement for future equity. And what that does is it precludes you from having to come up with a valuation, right? Because a brand new company, like what's the value? So if a client calls
Right.
and says, Lastly, I want to raise $100,000. How much of my company should I give up for that? Who knows? Because there's no way to value your company. There's nothing yet there. So Y Combinator, a group out of Silicon Valley, came up with this
Sure.
concept. And basically, it's a piece of paper that says, you give me $100,000, I'll give you a piece of paper that when we do get to the point where there's a value on the company and we raise more money at X dollars per share or sell the business, that 100,000 converts into that right to participate in that next round of financing or sale, but on better terms. So it's very complex, but the point for this particular question you asked is that it's very easy to give up, to like issue these safes and have all these investors come in. And you're like, oh, I raised all this money. What you don't realize is when they convert, you've diluted yourself so much. And so
Wow.
what happens a lot is you'll hear about oh, this startup had this crazy exit and the amazing founder made $50 million, except they didn't because they gave up so much of their company without realizing when they were in that fundraising process that in the end they're walking away with such a little piece of that pie. So that's the second one. Last one I'll say is founders usually are granted equity up front, like when they're granted founder shares. Investors want those shares to vest over time, and
Okay.
so that's a whole concept we can talk about too, or not. But when you have vesting equity, you have to file something called an 83B election with the IRS. It's like that QSBS. It's a huge tax benefit, and it's due within 30 days of the grant of stock, and there's no ifs, ands, or buts about that. And that's something a lot of founders don't know they have to file that, and they get tripped up, and it can cause really big tax headaches. So I'd say those three.
Interesting. So, uh, I'd love to get back to the vesting here in a second. But first off, it was interesting that you bring up equity, because I think that a lot of founders don't think about what their number is. And you had kind of mentioned that in the beginning about how much money do you need to raise. And so having, that budget so you can say, this is what we have now, this is what we need. Tell us more about that type of preparation.
Yeah, it's tough because your investors will, like, a lot of times I'll hear clients will say, I don't want to raise too little because it sounds like I'm not thinking big, right? Because investors, they don't care about your product, they don't care about your business, they care about how you're going to make money so that they can make money.
Sure.
So, if you say like, oh, I'm raising $500,000, a more sophisticated investor might say, like, where's that getting you? Like that, like, I don't want to invest in something where you're raising that little bit of money because you're not thinking about scaling this to some huge thing that we can, sell and make a lot of money on. On the other hand, if you raise too much money, you get back to that issue that I talked about, which is like you're giving up so much of your company, the ownership, that maybe you don't need to give up. So I know that there are some amazing tools out there that help you calculate exactly how much you do or don't need to raise, but you certainly need to be able to explain it to your investors.
Okay. So it's not necessarily about the dollar amount, it's about the justification of what that's going to be and how that relates back to what they're going to earn and how they're going to earn it.
Yes.
So get us back into a little bit more about vesting. You had mentioned that you could expand a little bit more, and I'm sure our listeners would love to hear more.
Yeah. So it's actually a really simple concept, which is when you get equity that's vesting over time, you own it, right? So I give you shares, you own them. But until they vest, if you leave the company, you lose whatever shares are not vested yet. So the typical vesting schedule for founders is over a 4-year period, and it's 20% vest over after the first year. 25% vests after the first year, and then on an equal monthly basis over the next 36 months. So what that means is in the first year, if the company were to pay dividends, which startups don't pay dividends, but if the company were to somehow be profitable and pay dividends, they're yours. If the company takes a vote on something, all those shares are yours to vote. However, so let's say like after year one, I gave you 100 shares. After year one, 25 of them are yours. They're vested. So now if you leave the company, you lose 75%, but 25 is yours to keep.
Okay.
Now, that being said, a good lawyer will build in a buyback provision into your agreements. Because let's say, I'll just really quick story. One of my biggest learning experiences was my very first startup I represented in 2010. And that scenario happened. So he hired this salesperson. He gave her, 10% of the company, vesting over 4 years. First year went great. 25% of her equity vests. They have a huge falling out. She walks away with shares in his company, and minority shareholders can cause problems for you, and she did. And so now I know, I've learned after that, like, always have a provision in your agreement with anyone you give equity to in your company, including your co-founders, that you, even if you have to go get an appraisal and pay fair market value, and that's more money than you want to pay, have the right to get your equity back.
Gotcha. That makes sense. It's, we think about, and I think I brought this up in a previous episode, but you do different types of agreements when you get married, right? You might be looking out for your best interests in case you get divorced, but the same thing needs to go for business entities. A prenup is what I was thinking of. You get a prenup before you get married to protect your assets. You hope that it doesn't go wrong, but now you have a potential just in case it does. Same thing with business entities. You need to be thinking ahead of time about what potential is going to be there to help should things go south.
Absolutely.
So moving kind of on, what is the biggest legal red flag that will scare away a potential investor?
So a lot of people will have someone early on, or more than someone, who helps them out, like as an advisor. And they
Okay.
say, like, they're sitting and having coffee, right? And they're like, you have been so helpful. You can have 1% of my company, or like, co-founders don't enter into an agreement with each other. And they're like, yeah, we're a third, a third, a third. It's all good. And then two of the people disappear. One of the person, one of the people disappears. They're no longer part of your business. And an investor comes along and is like, show me your cap table. And you're like, oh, well, I mean, this person supposedly had 1%, but like we never did any documentation. I haven't talked to them in years. They're not part of it. Yes, if you're successful, they are going to come back. I promise you
Sure.
that. So that is something, and I've been dealing with it today. I've got, three women who started a business together, couldn't come to an agreement on terms of their shareholders agreement, and it's two against one, and the one is like, no, I own a third. And she did nothing, and these other two women have been like busting their butts for a long time, and they're ready to move forward. And meanwhile, they want to put more money in to get the company going. She doesn't want to. And they're like, okay, well then we'll put the money in and you get diluted. And she's like, no, I didn't agree to that. Whereas it doesn't say that, and we have no agreement that says that. I'm not getting diluted. So it's a nightmare. So that is something where investors are like, if there's potential litigation, keep me away. That's really
Yeah.
like a big one.
Well, and there's a bunch of different scenarios that you gave within that example of ways that different types of legal potential disputes come up. And I think and I've purposely encountered different entrepreneurs who are like, oh, so-and-so helped me out, so I gave them a portion, and so-and-so wants to help out, so I'm going to give them another portion. And I think what's important for investors to understand is that you can appreciate and show compensation to some of these people who help you out without giving away shares of your business, without giving away portions of their business. And you need to have those conversations up front with people so that you're not just 1%, 1%, 1% because, oh, this person was nice to you and that's how you're going to show appreciation. So in that regards, what types of other ways would you suggest that people compensate instead of giving away those shares?
Well, I mean, you can listen. Sometimes it's good to give shares. Sometimes it's absolutely
Sure.
fine. You just have to paper it all, so you get the right to buy them back. Other things you
Yes.
can do, if your business provides some kind of a service, you can, give free
Give
services to that
services
person.
or goods or
Yeah, introductions, just like when people have done things for me, I'm always thinking of, oh, I have an event coming up and I need to put a panel together. This person, was really helped out a client of mine at some point. Like, I'm going to put her on my panel so she can talk about her business and, get her
get
some.
exposure.
Yeah, exactly.
And I think that's great. And I think I know I had an entrepreneur recently who had that problem. So I'm glad that we discussed that because you don't have to always give away pieces of your business.
Correct.
So let's talk a little more about legal. What are the actual laws founders need to know when raising money?
Great, very important question because most of them don't ask. And
Yeah, I'm sure.
they print the safe off the Y Combinator website and give it to their investors. And then they come to me for their next round when they're ready to raise from like real institutional investors who are like, where's all the disclosure? Because otherwise you could get sued and we don't want to invest in your company. So there's two, I'm going to summarize it really, really simply. There's two laws that matter. So when you're raising money and giving away equity in your company, you're selling securities. So you're governed by securities laws. That is to differentiate for a second between like Indiegogo, Kickstarter. Those you are
Sure.
not giving away part of your company. You're
Right.
getting money and you're giving someone like swag or early access to your product or that kind of
Profit,
thing.
the early buying of a product.
Yeah, totally different. Totally different. So when it comes to, but when you're selling an ownership stake in your company, you're selling a security. So there's two laws. Let's just, for non-lawyer sake, call them the 1933 Act and the 1934 Act. And yes, it goes back that far. The 1933 Act conceptually says that if you are going to publicly offer securities to people, you need to register with the Securities and Exchange Commission, the SEC. That's a giant, that's an IPO, that's a huge thing. It's hundreds of thousands of dollars. Obviously, no startup is doing that. So if you're not going to register, you need an exemption from registration under the law. The exemption that startups almost all use is we're not conducting a public offering. We're just going out to a few people, right? It's not public. So then, the SEC was like, well, what does that mean? Is that, one person, two people, 10? Is it, under X dollars? Like, how do we define public versus private? And so they came up with this concept that's under Regulation D, as in David. So you'll hear a lot of, I'm doing a Reg D offering. So what Reg D is it's a safe harbor that says if you follow these rules, you will be deemed not to be engaging in a public offering, and you're exempt from registration with the SEC. I'm not going to go into all the rules, but the basics involve. But the basics involve, like, you can't go on social media and say, like, hey, we're raising money, we have a great company, send checks, and you can't, and you have to, there's certain rules if you have anyone investing who doesn't meet certain income or net worth standards. So that the securities laws are very protective of people who don't have the money necessarily to be investing, so that, you don't go after widows and orphans kind of thing. So that's the basics of, that's one 1933 Act. Second one, which is even bigger and more important, is the 1934 Act. What this says is, if you're raising money, you have to tell every prospective investor whatever a reasonable person would want to know in deciding whether to invest in your company. So you can't just print the safe. You have to tell investors all the risks relating to the investment. So what we do is a subscription agreement, which is just an agreement the investor signs. I'm so-and-so, I'm putting in X dollars. I understand that I'm getting a safe. I understand how safes work. I'm not going to turn around and resell my shares and create a public market. I've gotten to talk to the founder and had all my questions answered. I understand that this is early stage and it's risky. I have the net worth requirements that this won't, if I lose my money on this investment, I won't, I'll be able to handle it financially. I've talked to my financial advisors, that kind of thing. And then we attach 2 exhibits. One is a description of the business and, like, what you're doing with the money, because that's something that a reasonable person would want to know. Like, are you taking this money and paying yourself salary? Like, that's probably not what they want to hear.
Not the intention.
Yeah. What is your background as the founder of the company? Like, how do I know you're, experienced enough in this industry to do this? What does the cap table look like? Like, what, how much am I going to own? That kind of thing. And then the second exhibit is the most important thing. It's a set of risk factors. Anything and everything that could possibly go wrong. And I get a lot of pushback from clients who are like, wait a minute, Leslee, you're telling me I got to, like, give my investors something that says, don't invest. Like, early stage startup, you're probably going to lose your money. We have tons of competition. We can't compete with them because we don't have the funding. Why am I doing this? And the answer is, your pitch deck is your sales piece. Your risk factors are your insurance policy. Because what's going to happen is, if, God forbid, people lose their money or don't make the return they think they're going to, and they call a lawyer and they're like, I'm going to sue this founder who I thought I was going to make all this money. And the lawyer says, did you sign any documentation? Oh yeah, I signed this thing. Really? Because it says here that you signed something saying whatever went wrong could have gone wrong. You knew that.
Yeah.
I'm not taking your case because you're going to lose. So that's
See
it.
previous conversation about making sure you are prepared when things go wrong.
Yes. I mean, that's what lawyers do, right? Like, it's such an annoying, I totally understand. I'm a business owner, so I understand. Like, it's such an annoying thing to spend your money on, because you're like, everything's fine. Why am I putting money into this? But it's like insurance. I mean, it's really,
right.
If something does go wrong, you really want to be protected.
Right. We all have health insurance, not so that we can go, to see the doctor once a year and get our checkup, because technically that's free. We go because when something goes wrong, it's going to really go wrong, and we're going to be really glad that we have it.
Exactly.
And really, my last question is kind of something that I'm really intrigued to hear is what is probably the one most important thing that founders wish they knew before they went through an early stage fundraising?
Huh. I think that I think it sounds very sexy to raise money. I think
Yeah,
it's
absolutely.
like, oh, I'm raising my Series A. Like that's, I'm so cool. I've got this cool business. I'm very, 21st century. It is so hard. It is
Mm,
so it's just you get so many no's. You lose
yeah,
faith in yourself. You it is a long process. It's really really difficult. And like when people talk about a Series A, when someone's writing you a check for $5 million, they have a lot of say in your business from then on. They're
yeah,
almost like they become your partner, and the relationship turns sour so often. And the CEO is very often kicked out. And
yeah.
that's the founder, it's your baby. And if this if, and what happens is clients will be like, oh my god, Leslie, they hate me. Why do they hate me? They don't hate you. They have a fund that they've raised of investors that are expecting them to make a
Mhm.
lot of money. And if they can't make those investors happy, they're not going to invest in their next fund, right? So this is the way they make their living. This is the promise they've made to their investors. They don't hate you. They think you're not making enough money with the company for them. And so you're subjecting yourself to so much scrutiny even when you do get the financing. So even though, I mean, it might be like an oxymoron or whatever that I would say, or ironic that I would say, as a securities lawyer who helps startups raise money, if you can avoid it, avoid it. It's a really tough process to go through.
Another episode that we had, we were talking to an entrepreneur where she was talking about being lonely as being an entrepreneur and starting your own business. You can feel so isolated. And so, what it sounds like to me is that this is also an isolating process and that it is so hard, and you have to have that perseverance to really continue in that work and push through. And, you hear all these stories about, Harry Potter, it took what, 46 no's or something like that before you get a yes. And so that's what in my mind it equates to, a Series A or getting funding is you have to have that inner monologue and that inner mantra to just keep going. And so it's important for people to know that before going into it, so that they can be mentally prepared.
Yeah, absolutely. And one thing I'll just throw in as like a bonus, something I learned that I didn't know recently, is that a no from an investor is not a no forever. So if you
Mm,
really target an investor and you're like, how did I get a no from this person who we're exactly within their investment thesis of their fund. Like we're exactly what they need. Why would they ever have done? Stay in touch with them. Don't leave on bad terms. Don't go, send quarterly reports. Let them know when you have, the next state phase of your company. If you went from MVP to a product in the, to a beta, and you're getting good test results, or you now have users, or whatever it is, stay in touch, keep up that relationship, because very often those investors do come back around and end up being your investors. So just something I think is important for founders to know.
well, it's why you don't burn bridges, number one. And number two, no's are really not right nows. There's very few that are actually like, no, absolutely not, never again, don't ask me. But most no's are just a not right now. And I think that also helps in that mental mindset. It's one of those things where you're like, okay, we got a not right now, we got a not right now, because not right now
Love
still
that.
leaves a little bit of hope, but the no is what slams that door shut and can actually change that mental mindset.
I'm going to use that. I'm stealing that from you. I love that.
Please, my gift to you.
Thank you.
Well, this has been a fantastic episode, Leslie. There were so many nuggets of information that I'm sure our listeners are thrilled to have heard. So thank you so much for sharing.
You're welcome. Thank you for having me.
And if you have any other questions or you want to get some more information from Leslee, we're going to put her email address in the description to this episode. Feel free to reach out. She is a proud resource and happy to answer questions. So again,
I'm
please.
sorry. I do a half-hour free consultation for any potential client. So
even better. I'm glad.
Sorry.
No, that was a great intro. You're always welcome to interrupt when you're adding value. Always tell me to shut up and go away. Well, thank you again for joining us on another episode of Building Up Your Business, the podcast. I am Erica Dill, your host. Remember, from bombs to order fulfillment, marketing to taxes, learn the stuff from the pros before you step in it. Our pro today was Leslee, all about early stage fundraising. So feel free to rewind and listen again, and we'll be back in another 2 weeks with another great pro and another great lesson. So I hope to see you then. Have a great day.